Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, my name is Ravi Singh. In continuation with our series on podcasts based on a quarterly India market outlook titled A Tight Balancing Act, in today's episode, we discuss a key investor question on fixed income investments. RBI and other global central banks have normalized pandemic-era liquidity and raised interest rates above pre-pandemic levels. Consequently, rising bond yields have made fixed income investments attractive both on absolute and relative to other asset classes. A common question in investors' mind at this point is whether it's time to add duration or increase the average maturity in the fixed income portfolios. Now, before we get into that discussion, let's understand some of the popular considerations why investors seek to increase the duration or maturity profile of their fixed income investments. First, generally bonds with higher maturity offer high yields compared to an otherwise identical bond but with lower maturity. This difference in yield is called term premium. Second consideration is the outlook on the future trajectory of bond yields. Generally, as bond yields rise, the value of a bond falls. In a falling bond yield scenario, bonds with higher maturity experience greater rise in value compared to an identical bond with low maturity. Now, putting this in perspective, in our view, bond yields have another leg up in the near term, driven by the following factors. First, falling Indian government bond yield differential with its global peers as inflation-focused central banks continue to tighten financial conditions. Second, worsening government bond demand and supply dynamics amid an expansionary fiscal policy and muted institutional investor demand. Third, waning optimism regarding India's sovereign bond inclusion in global bond indices. Further, upward shifts in markets' expectation of central banks' terminal policy rates amid still persistent and elevated inflationary pressures has led to a flattening of bond yield curve, with the term spreads between the 3-year and 5-year Indian government bond yields falling closer to 15 basis points from 50 basis points at the start of the year, while the spread between the 5-year and 10-year Indian government bond yields falling closer to 10 basis points from over 65 basis points at the start of the year. Nevertheless, the risk-reward for the bonds have improved with an attractive yield on offer and some of the incremental rate hikes likely priced in. The 1-year overnight index swap spreads suggest market participants expect the RBI to raise policy rates by at least 100 basis points over the next 12 months. We expect the 10-year Indian government bond yield to trade in a range of 7.5% to 7.75%. Overall, bonds continue to remain a core holding. Within bonds, we continue to prefer short maturity bonds over long maturity bonds, given their lower sensitivity to rising interest rates. That's it for today. Do reach out to your relationship manager for a copy of our India Market Outlook. Thank you for listening, and if you enjoyed the podcast, please like and subscribe.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered relationship manager or visit www.se.com/in.